Welcome to Street Talk, S&P Global Market Intelligence podcast that offers listeners a deep dive into issues facing financial institutions and the investment community. I'm Nathan Stovall, and on this episode, we're talking about the state of the banking industry and what the fundamental and regulatory environment means for bank M&A and capital raising activity and valuations in the sector. We just attended the annual Acquired or Be Acquired conference in Phoenix, and sentiment was quite high. KBW CEO Tom Michaud kicked off the conference to a pack house and shared his view of the space. We're fortunate enough to have Tom back on the show to talk about what he thinks of the group. Tom, thanks for coming back on the show.
Nate, it's great to be with you. Thank you.
So, Tom, something we've heard for some time from the investment community, bank investors, particularly those focused on community and regional banks, is that they're kind of frustrated with valuations relative to the broader market in particular. What's your view of valuations right now? And particularly when you think about the regional group, which has lagged bigger banks, do you think that's set to change?
But I do think it's set to change, and I think it's even starting to change before our eyes right now. And what's interesting is that when you look at regional banks, and we like to measure the Keefe Regional Bank Index, the KRX, because it's a very publicly traded, visible index. And so we use the valuation metrics of the KRX. And remember, the BKX is the Keefe Big Bank Index with the top 24 banks, and then the next 50 are in the KRX. So when you look at the KRX, you can say, oh, going back 15 years ago or 20 years ago, these stocks traded at much higher valuations. And we've just spent a decade or so trading at discounted valuations to that. And I was getting questions quite often about, will we ever go back to the levels that these stocks used to trade at? We're not necessarily, or I'm not making the case that we're going to go back exactly to 14 or 15 times forward earnings. That is generally, we saw those valuations in the past, but the gap was too wide to where it had been. And I think that there were two main factors on why that's happened. I think number one is the operating environment for the core bank model had been very difficult and challenged there for a little bit. The most recent example was the inverted yield curve that we had that ended in the fall in September of 2024. That yield curve was the longest inverted yield curve in 47 years. So it really pressured earnings for the banks, for the ones that are very spread lending dependent or margin dependent. And so these banks didn't show a lot of earnings per share growth. Many of them had earnings declines. And I think that the fundamentals weren't really performing as investors would like. No matter how scientific we want to get the study of the industry, investors like it when earnings estimates are going up and profits are improving. It's not really much harder than that. And there are a variety of ways to do that. You can grow, you can get more efficient, your margins can get better. So there are all these different things that can happen. And really, just one way to describe the fundamental moment in the past, most recent past, were lots of headwinds, okay? Now the headwinds have become tailwinds, okay? In the last week, we've had the longest 210 curve inversion of the year, and the curve appears to be steepening, which means that banks are going to have more maneuverability or more room to maneuver and to perform better. We also have a very stable and performing economy with really good credit quality for the banking industry, which it's actually so good, the industry's probably over earning because of it, and investors should know that. But still, nonetheless, we're now seeing profitability improve, we're seeing earnings grow, and we're seeing confidence come back. And then I'll layer one more on top of the valuation argument. The valuation argument was fintech and non-banks are coming for your customers. And so what impact is that going to have on banks? And a lot of bank investors were wondering if that was a long-term impact that would impact their investment. So while those pressures have not gone away entirely, I think the playing field's being leveled a little bit with the regulatory pivot we have in Washington. So my view would be, I think these stocks, the regional bank stocks, the KRX stocks, are in a moment where they're going to recapture some valuation discount that they've had to the bigger banks and to the overall market. And by the way, the discount to the bigger banks as the year started was really the biggest it's been in 5 years. So I think that this is going to be a good year for the regional banks because the fundamentals are going to drive it. The regulatory aspect of it is green light, and also we've got a little bit of consolidation activity on top, and the economy's performing well, and there are no signs that we're starting a new credit cycle, which usually can turn the fundamentals into a headwind if it changes quickly and significantly.
Certainly.
That was a long answer to your question, by the way. I hope you weren't ready, but that is the longer story to that.
No, and all those are really important factors and really drivers of profitability. And one of the things you talked about, is fundamental environment is improving, but you talked about AOBA. You had a great slide where you looked at valuations of the group, but also looking at their earnings contribution to the broader market and how effectively they're contributing more to the broader market, but yet they're lower
Oh,
weighted.
oh my goodness. I could start stacking up reasons why these stocks are attractive. I just gave you a few. Would you like more? Let me give you some more. Well, and I'll talk to that. So if you look at financials, so that is a bigger subset than just banks. But if you look at financials, they generally contribute 17 to 18% of the overall indices earnings. Yet they only get 12 to 13% of the market cap. So financials historically have traded at a discount to the market. Maybe it's because investors believe the market on average grows faster and it's a growth dynamic. But when you look at the financial gap between contribution of earnings to overall market cap, financials have the biggest discount of the 10 or 12 major uh, economic verticals in the market, dead last. So my view is we don't have to trade at a market multiple. We'll let the big hyperscalers, Meta, Google, Apple, they've got incredible valuations. We're not saying we're going to go marry that. But dead last for the fundamental outlook of the banking sector seems like a little too severe to me. That was the point that I made during that portion of my talk.
Particularly when you balance that against everything you mentioned at the opening there of a lot of positive tailwinds for the sector as we sit here today. One that you did mention though, and you don't think it's a potential headwind, but I just want to put a finer point on the fact about over earning on credit and the idea that we are in a period of credit normalization, but that doesn't necessarily mean a cycle, right? Is that the firm's view?
Yes, and there are a couple of things about that. Well, first of all, there's no doubt. I've been doing this for several decades. When there's a credit cycle, investors sell first and ask questions later. Okay. So, I mean, just think that that's what's going to happen. But when you look right now at the banking industry, a lot of the non banks have taken a good portion of the gamier credit
Mhm.
risk. So, that part of that conversation is a positive for the banks, but not all of it. Banks still have credit risk. But, but the other part here is the capital account. One of my early slides in that presentation looked at the KBW earnings models for the 211 banks we follow, and we forecasted capital. And what's emerged is that the industry has significant excess capital today, and it's going to grow considerably, which puts the industry in a position to grow organically, buy other banks, buy back stock, raise dividends, and then another point is have a fortress for credit.
Mhm.
And I think the banks are so well capitalized. So we're looking at a lot of tangible common equity to asset ratios now around 9%. 9%. So that's a big number. And to remind you, pre-crisis, the global financial crisis, Citigroup's tangible common equity to asset ratio was 1.5%. Okay. We've come a long way. So my point is that there is, and look, one of the companies that's doing very well, we recommend the stock, we like the company, Fifth Third, they wrote off a $200 million loan in the third quarter, and it was at best a speed
It did
bump
matter. Right.
because of and it was $200 million. So it was because of the fantastic strength of the balance sheet.
Mhm.
And I think that, that's a big part of the story is that the industry's balance sheet is just so strong.
Well, and to your point there, even if you had some great concern, if you're an investor looking at the space saying, everybody's got it wrong, there's something coming, and I'm not suggesting that's the case. Your point there is there's tremendous loss absorption sitting on these balance sheets. And I'll mention, you didn't mention, but reserves are way higher too. Uh,
Oh
uh,
yeah. Oh yeah.
so you've got a strong earning stream against that. But if you even had doubt there, they're prepared to handle it.
It's the the green lights for this sector right now are very good. Strong balance sheets, good and improving profitability profile, changing regulation in their favor, and the economy's good. It's green lights on this trip right now, and I think that's why. And then we didn't even get for the biggest banks. The biggest banks that have investment banking platforms have one of the best investment banking pipelines in a really long time. So the big banks are driving more performance too. So I think the sector is a very attractive sector to invest in at the moment.
Let's talk about the big banks. Having the markets related businesses certainly helps their earnings profile, but there's also this belief that scale matters a lot and is an important driver of valuation in many investors' minds. Do you think it should be?
So scale is really, I think, really important, but I think it's an important feature of companies that keep driving better performance. It's an important common. It's not the only feature, but but I would not be if I was running a bank and governing a bank, I would not want to be big for the sake of being bigger.
Mm.
Because and I don't mean to be picking on Citicorp. We actually recommend that stock and Jane Fraser's doing a nice job of turning it around. But Citigroup is 2.6 trillion in assets and hasn't earned a double-digit return on equity in a really long time. It's only going to happen this year. So being big has not helped their performance one iota. And then when you look at of the 211 stocks we most closely follow, the five most highly valued on a price to tangible book basis were all below 10 billion in assets. So there are exceptions to the rule everywhere, but the median statistics are tremendously powerful. And what it says is it's a two-step process, I believe. One is we think the highest correlation for bank stock valuation is return on tangible common equity to price to tangible book. The higher that is, typically there's a regression line. It says the better stock price you get. But there's a second dimension that makes that correlation even better, and that is volatility and variability. So if you do, and now this is just kind of common sense, even though we did run the models, the more profitable you are consistently, the higher your valuation. And then if you got a group of really smart bank executives together and said, how do we do that? Well, you take efficiencies out, you get broader businesses, and usually it's because of scale. And then scale allows you to make the investments that you need to survive. And if you don't have the scale to make these investments, you run the risk that stablecoin or some other development will be so powerful, it'll jeopardize your core model. So, I mean, to me, it's like an equation of optimization of all those factors coming together. And that's what these management teams have to manage to get a better, higher stock price and a more profitable bank.
Yeah, and you talked about that some too, about the challenge of being able to control costs without getting larger. And I liked how you framed that it allows you to invest to remain competitive, but also create those durable earnings. And as you said, I like to put it, there's a price for certainty. It's a premium. There's a price for uncertainty. It's a discount, right? And if you look at those five
Yep,
banks you mentioned under 10 billion, they are so consistent. You could set your watch to them. They, just clicking off very high double digit ROEs every quarter. And I feel like investors are and they've built the trust with the investment community. And so they're going to be rewarded with a higher valuation.
exactly.
So let's shift to M&A. We're talking about AO, but it's an M&A conference. Expectations I thought were really positive. You talked about a friendly regulatory environment. You talked about a good fundamental environment and reasons why valuations should be higher, higher valuations, friendly regulatory environment. That sounds like a pretty good setup, particularly against coming off a couple of lower years. And we've already seen a pickup. What do the pipelines look like right now for the firm?
Well, that is a that's a little bit too specific of a question, Nate. So I don't think I can't answer that
Well, then
specifically.
what is your
But
outlook?
what I
How about
let
that?
me talk about this. Let me talk about the
Sure.
cycle. Our pipelines have been good for several years, and I expect them to be good for several more. So I'll leave it at that.
Sure.
So let me be careful on that. But for the industry is consolidate the environment and the factors for consolidation have picked up.
Mhm.
And just to kind of unpack it real quickly, remember, the industry's been consolidating since the mid 1980s when Congress passed the interstate banking laws to allow consolidation. So it's not like the industry decided to do it on its own. Congress gave them the ability to do this, okay? And so it's been consolidating since then. It has picked up now for a variety of reasons. One is the economy's good. Usually, when there's a credit cycle, you see less consolidation. So banks feel better about themselves and potential partners. The regulatory environment has pivoted. Now, I don't, it's funny, when I would like to define deregulation in this administration, in my opinion, it looks like it's stark, but it's stark because the prior administration, in my opinion, was the most aggressive at using the banking agencies to tighten things up along the lines of that administration's wishes.
Mhm.
Basically, not a single bank above 200 billion in assets bought another bank for 3 consecutive years. If you went back over history, that's like not happened before,
Mhm.
okay? And it's because it was demanded that way. So while it looks like it's something tremendously different, it's really a cessation of a blockage and then a restart, and then you had pent up demand. So that's why it looks really robust all of a sudden. But the regulatory environment matters because now you can get banks approved and closed in under 6 months, which is the way it was originally. So a lot of the pieces have been put back to where it was. But I wouldn't say it's just because of the regulatory environment we're seeing this consolidation. We're seeing this consolidation because these banks are trying to build better banks. They're trying to build more profitable banks. They're trying to build the scale to make sure they can, when they get to the tech investment fork in the road, they're on the right side of it, and they want to compete with non-bank competitors. And I also showed another slide in this deck, which shows it over the last 30 years what's happened to the market share. The market share's really gone from the sub $10 billion banks to the top 25 banks in the nation. The mid-sized banks have maintained market share, but it's taken 100 banks to do that instead of 50. But nonetheless, when you define the mid-sized banks, they've kept market share. I personally believe these mid-sized banks have kept market share because they've gotten big enough to compete with the biggest banks. They can't compete with them everywhere and in all business lines, but they've created enough scale and diversification that they can do that. And so I think consolidation has been really good because these mid-sized banks then become what I call regional champions, where they just mean that markets aren't dominated by three big banks. and then a lot of really small community banks who really can't serve the mid-sized commercial sector. So my opinion is the competitive marketplace is demanding it. The economy's allowing this wave, um, and the stock prices are allowing it because valuations are back up. So these are the factors are on why I think we've seen a pickup.
You mentioned the lack of large buyers previously. We got them back. How does that
We got them back.
change maybe the calculus of a regional who might not have had a buyer before? Does it? Do you think it brings more sellers into the
I
fray?
mean, I will first of all, let me first of all tell you, I think there are more banks that would like, there are more banks that would prefer to marry with a bigger bank than there are bigger banks that are looking to buy smaller
Hmm.
banks. So there are more sellers than buyers.
Hmm.
Okay. And I would have said that 3 years ago, 4 years ago, 5 years ago, and I believe it today.
Hmm.
So there's really a small group of able and prized buyers for each bank. And back in the 80s, if we when we were doing this, there'd be 12 or 15 buyers. Today there might be two or three.
Hmm.
There might be one. There might be one. So that dynamic has changed. But what's good, so there are two forces and they're tied together. The president has worked very hard to make sure that the courts agree with him that the agency heads work for the president. That means the next president's going to have the same power and the same features. So what's going to happen is a lot of these sellers think they're on the clock
Hmm.
because if the presidential election changes, you may get a policy that prohibits these big banks from being buyers. So if you think that you are a seller in the next couple of years, you should probably do it while the biggest banks are in the market rather than running the risk of doing it when the bigger banks aren't in the market. And that's another category, which is have we introduced regulatory volatility into the management of this industry? And I think we probably have.
Hmm.
It's unfortunate, it's not great, but now as a management team and a board, you got to think about that. So I think that's another reason why we've seen a burst, which is if you're thinking about selling your company, you should probably do it where there are bigger, more capable buyers who are in the market who are not have not always been allowed to be in the market. And so I think that's another reason why we've been seeing more consolidation.
And to put a finer point on that too, you're not suggesting that suddenly people who would not be a seller are just showing up. But the point is, if it is something that you think is in your future, you should recognize that the window might not be there further on the horizon.
Yeah, it's almost like, well, what's happened? Yes, and also too, the economy could
Right.
change. Our forecast is not for the yield curve to flatten, but I mean, there are a lot of things that can change. There's no birthright that says if I want to sell my bank tomorrow for a big premium, I can do it. It doesn't work that way. So yes, and also too, remember the reason why it feels so robust now is there's some catch up for that 3 year period where there were no big banks in the
Right.
market. And now there's a pull forward because of a fear it could happen again. And suddenly you're in a moment where it feels like it's a big burst.
Right. Right.
So it's a combination of both those factors.
One of the other drivers that you mentioned in your talk was how we've seen a little, I wouldn't say a big rise, but we've seen a new activist really emerge. With Holdco, you mentioned PL too, but they've been out there for some time. And we've seen them target a few banks. Everyone brings up the Comerica example. Are you seeing more of that activity? And maybe even framing it differently, how big of a factor do you think that is in terms of influencing these decisions?
I think it's a big factor, and you don't even need more activists to make it a big
Hmm.
factor. Holdco may have been enough,
Hmm.
meaning they may have made a big enough impact. And I think what's happened is, they've really, I think, put a spotlight on M&A. And it's interesting because they've called for some of their portfolio companies to sell, while at the same time they've been highly critical of banks that have bought.
Right. Right.
So hopefully there are deals in there that they think are well-designed deals,
Right.
because it can't be sellers shouldn't sell and buyers shouldn't buy, but let's have my bank sell. You can't have that. So what's interesting, what I think it's done is it has really brightened the spotlight on these deals. And look, the market, without being the market in some ways been an activist. The market has not been kind at times to buyer stocks.
Hmm.
That's a different form of activism. Maybe it's not putting out a presentation deck, but but I can tell you, having been around these management teams, is the board and the investors sometimes have and the investors that are most vocal have a timing mismatch, which is the investors might not want to wait. Well, in the past, with the lengthy approval times, didn't want to wait for the close, wait to see the execution. It could take 12 to 18 months to see if this deal was working. Thankfully, the faster they close, you can find out quicker how they're working. And frankly, I think the level of execution is going to be better because they can close them faster. But the market has not been always kind to these mergers, even though I think once the banks get a chance to, because the boards have a more intermediate or longer term
Right.
focus to these mergers. So I think that mismatch is what you see in a lot of the price action immediately after. But I'm not so sure if you're going to see a lot more activists appear. But I do think that Holdco's impact on the industry has been notable, because the companies where they've been active or visible just know that there's a brighter spotlight on their actions, and that they got to be ready to explain what their actions are. I think that's been the biggest impact, but I do think consolidation in the banking industry is still going to happen.
For sure. And in closing, just on that last point, we heard late fall, sort of close of the year, a number of regionals almost kind of downplay their interest in M&A. But I was almost in the camp, and particularly as we've seen regionals continue to participate in deals, that it was more of what you were just saying. We're going to be good stewards of our capital. And that's what I felt like that I heard, that they were trying to thread that needle to not say, no, we're not going to do anything, but we're going to be thoughtful about anything we do. And maybe that's the lasting impact here. I don't know if you would agree with that, but that there is going to be a vote on your action in the market now, and management teams are very aware of that.
I think that I think there's more share repurchase, in part because of Holdco's actions.
Hmm.
And so I think that when you think about I think capital deployment is one of the real positives to being an investor in this space. The industry's just it's the best, it's the most and best capitalized I've seen it in my career, and that's an asset.
Right.
I mean, that gives these management teams options. And there's nothing wrong with buying back stock and raising dividends. So I think you're going to see more of that, which is still going to be good. But I agree. But I want to also talk about another thing that I said during my presentation, which is I believe we're in the end game of consolidation. There are 130-ish banks over 10 billion in the United States. When you and I do this podcast in 5 and 10 years, Nate, and we look back and say which banks emerged to be the long-term survivors, it'll be most likely from those 130
Hmm.
banks. Okay, we kind of know who they are. There will be some maybe that emerge and create tremendous value, or maybe a digital bank comes out of nowhere or something like that, or comes on strong. But we kind of know the players now. And when you look at some of the potential merger candidates, a lot of them are over 100 years old. I think the founding banks of Cadence Bancorp are over 100 years old. There are a lot of these banks like that, and these are core deposit bases in on Main Street America that won't be reproduced.
Right.
So if you're putting together a nationwide banking company. And meanwhile, you've got JP Morgan in their investor day telling everybody they want to have 15% of the nation's core deposits. They're doing it and they can't buy because they're over the limit. So they're opening branches in all these cities around the country. And I will also say something I'm very supportive of, and hate to almost say the word proud of, but supportive of, is all these banks are thinking about core deposits. We didn't talk about that. I did say that during my
True value of the franchise, most important thing.
it 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 is actually the amount that should determine how big your bank
Right.
is. Okay? You can't go build a bank without core deposits. So, when you, in some of these states, there are 100-year-old regional banking franchises that are unique. And when PNC bought First Bank, what I believe management said was, "We just locked up Colorado.
Right.
No one else is going to go build that market share in Colorado while we're sleeping tonight.
Mm-hmm.
It's just not going to happen. It's not going to happen in our careers that someone's probably going to organically go replace that deposit base." So, strategically, when you think about building your bank with core deposits, if you want to be a nationwide or a big regional player, and it's tempting, or not tempting, very sound strategy to look at these core deposit franchises and how they can help your bank in the next 5 and 10 years. And that's the mismatch I'm talking about when I talk about some of the investors and how they think about these deals in the first day reaction.
Right, you can't replicate it, and that example of First Bank is a great
Yes.
one. I mean, when you look at it, that deposit franchise was enviable. Whether it's things like deposits per branch, cost of deposits, non-interest-bearing deposit concentration, they're way above the median on everything and in huge concentrated market share. So,
Yes.
I think it's a great point.
And it's offense. It's not only offense though, but it's defense. Let's go back to 2023. Which banks were most stable?
Mhm.
The ones that had a lot of core deposits, not the ones who had a lot of deposits above the deposit limits or that were more purchase deposits. Those were less sticky in a crisis. So to me, I can't blame these boards and managements who think about looking at these deals. And again, it's all about optimizing. You don't put it into a calculator and the answer comes out. You gotta manage it and consider all the different angles to it all to make these decisions on what it is you're gonna do. And I have to tell you, I love having those conversations with these management teams and these boards because I think it's a fascinating time, and it's a fascinating time to see the industry stand up to then turn around and go compete with the non-banks and the fintechs, whom, by the way, I love a lot of those companies too, and they're very good companies. But I think the banks had been on their back foot for years, and I think now they're able to be on their front foot, and I think they're going to take some market share back. Another point I made is JP Morgan has told the street that they spend $18 billion a year on tech. My firm did an informal check around the country. You can't really come up with more than 10 companies that spend over 18 billion on tech. So, but now look, there are some companies who spend a lot more than 18, the hyperscalers, a lot more than 18 billion, but that's not the point. But the point is, if most of the tech industry, they spend more money on tech than most of the tech industry, they've got a pretty good, firepower point to compete on tech. And hopefully the rest of the industry, to the extent someone as big as JP Morgan spending that kind of money, there's not a lot of copyright protection on some of these products in the sense that you could be a fast follower. So hopefully the adept companies can adapt and be fast followers and continue to build the banking industry.
They can play offense again. We've got tailwinds at our back, and we no longer have roadblocks in our way to innovate and expand. That's a positive message. Tom, really appreciate you coming on the show. It's a great place for us to leave it.
All right, Nate, great to be with you.